All right, we're here with our 2025 insurance outlook, and I'm already exhausted before I even start. So we tend to do these once a year. The point of them is to catch up with all the newsletters that we put out. So we put out newsletters at least every month, sometimes twice a month, depending on what's going on in the markets. Now, why do we do that? We do that to educate people on how to make claims, when to make claims, what's going on with carriers, what's going on with the markets, right? So we did this in 2024. A lot of people liked it, so we figured we would do it again. Obviously, there's no shortage of things to talk about. I think it's news you can use, but you might want to pour a drink first. So anyway, boys and girls, we're going to start with a look back from 23 to 25 weather events. All right, so last year alone, natural disasters caused $368 billion in losses. So again, in our previous video we did, I think it was prior to 1990, there was only maybe 25 storms to ever reach $1 billion in damage. And now we're having 30 or more a year. Last year, $368 billion in losses. Of that, 60% of these losses being uninsured. So there's a big thing, especially in California, Texas, other states where people are going bare. And what going bare means, they feel that they don't want to pay for homeowners insurance anymore, so they don't have any. And obviously, if you don't have a mortgage on your home, you're not required to have homeowners insurance. However, with the volatile weather system and everything that's been going on coming out of 23, 24, and 25, if you kind of look at the trends that are going on and how heavy these storms are getting, not only do I think you shouldn't go bare, another thing I want to talk about is extended replacement cost, right? So there's three values to a home. Market value, what you pay for it when you buy it. Loan value, what you're borrowing on it if you have a mortgage. Third is replacement cost. That's the cost to rebuild in today's dollars. And those numbers are up and down. We know that lumber went up 364% during the pandemic. So again, with supply and demand, if we have a widespread issue like Joplin had many years ago, and now Netflix just came out with a documentary on that, when you see a large area get hit, obviously materials are now supply and demand, which means they're going to go up. So maybe 100% of replacement cost, depending on where lumber's at, might not be sufficient. So with all of our homeowners policies, we add what's called a 25 or 50% extended replacement cost rider, which will cover those inflationary costs to make sure that you have the money to rebuild. Going bare, not an option. All right. Carriers coming out of 23, 24, 25. It doesn't really matter whether they're a captive carrier or they're offered through an independent brokerage like ours. They're all at a 96 to 115, 120% loss ratio. What does that mean when they're over 100? That means they're sending out more money than they're bringing in. It's not feasible. And why that's happening is, to give you an idea, let's say a home in California that's $2.5 million was paying $30,000 a year in property insurance. When you have one of those burned down, think about how many more of those you have to insure at $30K to make up 3.5, 2.5, whatever the replacement cost is. The answer, too many. And so when you see widespread events like California or North Carolina, it's just not feasible. And so reinsurance is taking the brunt of that. Reinsurance is where the carriers buy their insurance. And they raised the rates to carriers in 23 by almost 50%. So that's causing this trend with rates. So you're seeing that. Furthermore, about a year ago, Tower Hill, which was a big Florida insurance company, they came to the Midwest to write what I would consider less theatrical weather events. However, with the Midwest, and really the Midwest in general, which is raising more claims than both coastal companies, we always like to blame Florida and California for the rates. Ideally, Missouri, Kansas, Texas, Illinois, Ohio, Nashville, those are Carolinas. Those are all raising the rates for everybody, actually, with the volatile wind, hail, flooding, unfortunately. And so with that, Tower Hill is already pulling out of most of these Midwest states. They just came to Missouri about 2 years ago, to my knowledge, but they're already leaving there. Guard, which is owned by Berkshire Hathaway, they got out of the personal lines, so they were writing homes as well. They're no longer writing homes at all. They are getting rid of all of that business. Another carrier update, Safeco becoming Liberty Mutual. So Liberty Mutual bought Safeco some odd years ago, I think over 20 years ago, and left it alone. Safeco was kind of its independent channel, only offered by brokers, where Liberty Mutual was their captive agent side. Both of them together bought State Auto a little over a year, maybe 2 years ago. With that merger, so State Auto's no more, and Safeco's name is also going to set in 2026. It will all just be Liberty Mutual. More to come on that. Obviously, percentage wind and hail deductibles. This didn't used to be a thing in Missouri, except maybe back in 2013. Now we have back to percentage wind and hail deductibles. In the Midwest, they're mainly 1%, and that means 1% of your replacement cost on the home is the deductible. In states like Texas and several others, they've went up now to 2% wind and hail. And a lot of that's doing just the amount of hail in that state. So I know people in Texas that have gotten 3 roofs in under 5 years. So that's kind of driving the premise behind wind and hail deductibles. A lot of carriers changing roof rules. So in the Midwest particularly, it used to be 15 years or newer, you got replacement cost on your roof. If it was older than 15, you got depreciated value. Now that rule is 10 years or newer, as opposed to 15. Furthermore, there's a couple carriers now limiting the size of roof that they will write. So a lot of them are limiting them to 4,000 square feet. Now to give you an idea, a 2,400 square foot house with an A-frame, a pretty steep roof on it, will come in over 4,000. Why? Because we run these all the time and I see these all the time. 4,000 square foot of a roof is not anywhere near as big as you think it would be in regards to that home. That's another way carriers are protecting themselves, knowing that wind and hail seems to be most of the claims we're dealing with across the United States. Another thing I want to talk about too, with this hail coming in, it's very important to be cognizant of the contractors you're dealing with. So we've seen a lot of roof claims, a lot of hail claims come through, particularly in our state and several other states. Is about maybe 2 weeks ago, 2.5 weeks ago, there was over 100 tornadoes that touched down in the Midwest. So we've been kind of dealing with that, the cleanup of all of that. One of the things that come with that is storm chasers. And I don't mean the kind that are chasing the storm down to get it on film. I'm talking about the ones that come in, out-of-town roofing companies, out-of-town contractors, out-of-town paintless dent removal guys. Why it's important to really be careful who you're doing business with is some of these bids that we've seen, and because we see a lot of bids, we kind of know where the range is on roofs. And we had one recently where a client sent in a bid, and the roof was, I want to say $28,000 for this house, and this house I think is like 1,900 square feet. And most of the bids we've seen for houses that size were anywhere between $13,000 and $16,000. This bid was $28,000. Now again, it's always important, rule of thumb, to always get 3 bids. Why is that important? To really see what the going rate is. To lock in a bid that high, even though there's chances your carrier or adjuster might pay for that, is it necessary? No. The other thing you might want to consider around this roof situation, since we're all getting new roofs here, is not getting a 30-year architectural shingle. Now again, an insurance company's not going to dictate on the style and kind of roof you get. But knowing that insurance carriers, and in particular the Midwest right now, aren't offering replacement cost after 15, in some cases 10 years, there's no reason to get a 30-year roof. They know it's going to get hit by hail within that time, and you're also not going to be insured to 100% of the value. I understand why a roofer wants to sell it. It's more money. I understand that sometimes a 30-year roof may be more durable, but in the event of the hail we've been seeing in the Midwest, it really doesn't matter. Just shy of a metal roof, it's going to be damaged. And so to run up a $30,000 claim when you might need a roof again next year isn't always feasible. So do your research on who you're dealing with as far as contractors. Be very careful on who's knocking on your door. Most in-town roofers aren't door knockers. They're not looking for your business. They'll know you call if you need something, so that's important. So one of the things I want to talk about here in regards of wind and hail and damage, construction materials are through the roof. Not as high as they were during the pandemic, but they're going up again. Supply and demand when you have these widespread events. One of the things that's going to affect some of these things in regards to rebuilding or replacement, supply chain, etc., are going to be some of the tariff impacts, rebuilding efforts. 25% on goods from Canada and Mexico and China will delay rebuilding from natural disasters like hurricanes and wildfires. Rising cost for construction and auto repairs. Tariffs will increase the cost of construction materials and auto parts, which further raise repair and rebuilding expense. And supply chain in the automotive, if you've had a car in a body shop, you know that they're usually months behind. It's hard for them to get labor. It's hard for them to get parts in the supply chain. All of this is going to disrupt that. So, the disruption of the supply chains, there's going to be many things, in particular, building materials, because we get steel and wood from a lot of places. A lot of them come from Canada. So we're going to see a lot of potential insurance hikes because of these tariffs, because if 2x4s cost more, steel costs more. That's why you keep seeing the replacement cost of your home, FYI, going up every year. They're trying to keep up with construction costs, which are getting really out of hand, to be quite honest. Tariffs can have a bigger economic effect. Again, I'm not talking about tariffs from a political standpoint. I'm talking about them from a supply chain and reconstruction insurance cost, which will have an effect. Record shopping and switching. Auto policy shopping, switching rates hit a record high in Q4 of 2024. So people are shopping for rates. Here's the thing that I want to tell you about insurance. Insurance done correctly doesn't really look different from carrier to carrier. With that said, not every carrier offers the same thing. This is another thing. We have this on our university, on our platform. Why you don't shop with your deck page. Okay? Because not every carrier has the same policy form. Travelers offers things Safeco doesn't. Safeco offers things differently. Cincinnati offers different things than Travelers and Safeco, right? They're on an HO5 where they're on an HO3. I'm not going to get into all the nuances, but you really need to be careful on what you're purchasing, because when you get a quote and you match it up against your deck page, and what is a deck page? It's the one that has coverage A, replacement cost of the home, personal property, all of these things, just like with your auto. Here's your coverages. What's not usually included on that quote is the endorsements and the exclusions. That's what separates one policy from another. That's where the meat is. So you got to be very careful, because if you have one company matching everything you have in this current turbulent market and one's $1,000 less, that should actually behoove you to ask more questions than just move forward with the savings. Because again, a reduction of about $100 on a policy can be the difference in six figures in coverage. So you really want to vet that out. The other reason why we don't encourage a lot of shopping right now as well is you have tenure with your carrier. And carriers are looking for tenure, meaning how long you've been there. They can look at your MVR, your motor vehicle report, and insurance history and see how often you move around. And they're looking for that. They're looking for people that want to stay and play, not the ones that want to bounce around. You have the right to shop your rate every year, but just know when you're the newest client with no tenure, you're typically going to be the first to get cut if they have to make cuts. And believe me when I tell you, insurance companies are making cuts. They're trying to get profitable. They do not care about market share anymore. So carriers are looking for reasons. They're doing second inspections. They're doing a lot of things, limiting roof size, limiting roof years, doing a lot of things to purge business off the books because they're sending out more money than they're taking in. So you got to be cautious about shopping because rates are higher everywhere. There's no such thing necessarily as a low rate right now, which we're going to get into a little bit. One of the things I even want to talk about, right, is where people don't understand with home and auto and they go, where's the end? How high is it going to go? Here's the reality of home and auto insurance, okay? In Missouri, a $300,000 dwelling's on average $2,100 a year. The average roof claim is usually about $16,000, okay? So we know that you're going to pay $2,100 and you're going to be eligible to get a $16,000 roof. I want you to keep that in mind. Health insurance, 2024. The average annual health insurance premium is $8,900 a year for a single and $25,000 for a family. People use home and auto insurance more frequently than they use health insurance. Now, there are cases, medications, etc. But the reality of it is we know that we're paying. Like me, I pay $680 a month for health insurance. I've not met my deductible in 12 years. But I know that I need it in the event of worst case scenario. However, my auto insurance and my home insurance is significantly less, maybe 1% of that. And how often would you use that? Often, right? Average car accident. They say you got a 1 in 300 chance of being involved in a car wreck every 1,000 miles you drive. So the thing you have to understand is the average car on the road being 57 grand, the average auto accident now being $12,000 to $18,000. That's where the money's getting spent. Your auto insurance is far less than your health insurance that you use less frequently. But here's the thing, we have to look at this. Insurance is asset protection first. It's called property and casualty insurance, not inconvenience insurance. And the problem is too many people are getting roofs that may not need a roof because they're only getting one bid from the guy that's doing everyone in the neighborhood. People aren't vetting out insurance enough and they're using it in too many frequent ways that's driving up rates. Let me give you another example here. Roadside and windshield glass claims are claims. They're comprehensive. So we know collision. If I hit another car, that's a collision claim. Anything else is comprehensive. Hail on the car. I hit a pole. I hit a deer. Somebody breaks into my car. I get a rock. I need a windshield. All of that's comprehensive. It is a claim. People misunderstand that if it's not collision, it's not a claim. Everything is a claim. It is reportable. And the problem that we see is a lot of people using roadside far too often or using glass coverage far too often, and it runs up the rates. Carriers do not look for the amount of one single loss. They look at the frequency at which the policy is getting used. Insurance, in theory, was not designed to fix a rock in a windshield. It's designed to fix a car when it's totaled. It's designed to help somebody if they go to the hospital due to bodily injury or property damage. It's designed to put your house back together when a tornado completely disintegrates it. It's not meant for these inconveniences. And we're not here to tell you how to use your policy. However, that is what's driving up a lot of this rate outside of weather. Weather's predictable. Using your insurance for inconvenient things is one of those things. Protection gap. So 1.8 trillion protection gap. There is a global 1.8 trillion protection gap, which refers to the difference between insured and uninsured losses, with a significant portion of natural disaster losses being uninsured. Now, why are some natural disasters somewhat uninsured or controversial? Well, we know that most wildfires aren't wild. Okay, they're usually set by humans. So they're not, even though they classify that as a wildfire, it's not technically a wildfire. Similarly with North Carolina, unfortunately for that big storm in North Carolina, a lot of that was flood damage. Now these individuals did not have flood insurance because they weren't in a traditional flood zone. And so that's a problem with these gaps. 78% of insurance executives in the industry believe they have an ethical responsibility to close this gap and provide better coverage to underserved regions. Closing this protection gap presents a significant business opportunity, with 76% of executives seeing it as a chance to grow the insurance market. Natural disasters impact last year, 368 billion losses, and again, 60% of those uninsured. Here's the thing, I've been in this industry for a very long time, and I've only ever seen 2 claims get denied. One was due to maintenance. The other one I couldn't agree with. Outside of that, the many thousands of claims that I've been involved in, I've never seen claim denials, and I'm going to tell you why. An appropriately built policy will show up the day of. The problem is people only call carriers that they do not know to get a lesser price than they were paying last year. They're looking to save money, and I understand that because insurance is going up. You should want to save money. But when you call these 1-800 centers, their job is to get you exactly what you asked for. And I always say if it's all about price, eventually you're going to pay the price. You have to be educated on what you're buying. So let me give you this analogy. If I was to go to a nice steakhouse tonight and order a dinner, and the guy says, and I go, hey, what's the special tonight? And he goes, we got a great 8-ounce filet. And I go, that's fantastic. What happens when I say I'll have the filet? He's going to ask me, how do you want it cooked? Rare, medium rare, well, medium well, done? How do you like it cooked? Then I tell him I want it medium rare. That's the end of the conversation, right? And then about 10, 15 minutes later, my dinner comes out, I eat it, and I go home. That's the problem with home and auto insurance. You're calling to just get a cheaper price, right? The guy's not telling me what the name of the cow was, whether he was grass-fed, how long they had the cow before they killed him. You need to ask questions on these policies. Do I have extended replacement cost coverage? Do I have utility line coverage? What are my deductibles? How do they work? A lot of people have earthquake, and the standard earthquake deductible is 20%. That's 20% of replacement cost. Most people could never afford to even use their earthquake deductible in the event of an earthquake. That's why we sell policies with a 2.5% deductible. But we don't wait for our clients to ask those questions. We start asking them questions about their lifestyle, about their assets. We build the policy around that. They have to be custom to the individual. A carrier can't be all things to all people. And when you ask to save money, they will. But it's always at the exception of protection. So we just try to reiterate that each year, that you need to be looking at these policies. Are you in a wildfire area? Does your carrier offer wildfire coverage? Maybe they do. In Oregon now, Safeco offers it at no cost. These are questions you need to be asking yourself. But here's the hints of it, folks. So 2025, here's my outlook. I think weather's going to get more radical, whether you want to hear that or not. And the reason being is it's only gotten more radical. 2023 was bad, 2024 was worse, and 2025's already superseded both of those in reality. And it's still a gift that keeps on giving. So we know that we can't predict weather. We can't figure that out. What we can predict, though, is how do we have a poorly built or a well-built policy? Do I understand my policy? Can I build my policy with higher deductibles to be used for worst-case scenarios, which the way it was designed? Okay? When you run up roadside claims and glass claims or infrequent claims, and again, I don't tell people how to use that policy, but the problem is every carrier that you're shopping insurance does a 7-year look back. And they're looking for clients that have 2 or less claims over those 7 years. And again, sometimes it's circumstantial and you can't avoid it. But you need to be asking different questions. Not how much money can I save? Can you find holes in my policy? Am I adequately protected for most of the things that are going to happen to me in this state? Am I near a flood zone? Flood zones change every year. Maybe you need to look that up. Maybe it behooves you to buy a flood policy for once. I don't know that answer. But the reality of it is you got to put your seatbelt on. I think it's going to get a little worse before it gets better. Insurance carriers are trying to get smarter on what they like and what they don't like to bring these rates down. But one of the ways that we can all effectively bring rates down is by avoiding claims that don't need to be made. And a lot of times we see a lot of people get roofs because their neighbors got a roof without getting 3 or 4 estimates to really dictate whether they have hail damage. And I got news for you folks. Roofers are always going to want to sell you a new roof. But the problem is when you get a $30,000 roof for a $1,500 deductible and everyone in your neighborhood does that, that's hundreds of thousands of dollars of claims for tens of thousands of money back on the insurance side. The only thing they can do to get their money back is to raise the rate. So this is our predictions for 2025. I think it's going to get better before it's going to get worse. A lot of carriers are changing their appetite. There's a lot of carriers getting out of this personal lines business where that's where all the volatility is. And we're just going to ride that wave together. However, when we've had clients at least 5 or 6 years and we do a look back, most of them are still 50% under the market in any of the 17 states we currently insure. And the reason being is we meet with our clients every year to go over their needs, wants, and desires and make sure that their policy is going to hold up in any case, regardless of what can happen, because what can happen will happen. And if you're not a client of ours, why don't you just reach out? Get on e3insure.com, drop us a line, give us a call, Google us, okay? My challenge to you is, if you're not confident what you currently have, reach out to us directly. We will review all of your policies at no charge to you and tell you exactly what's going on with them. We will give you a health report, a report card, if you will, on your current policies. We do this for a lot of financial firms and for a lot of clients we've never sold a policy to. But if you're curious or you're wanting to know that in that junk drawer where you put those policies every year, even though it was a good price last year, if it's going to show up in the event of what we're seeing going on, give us a call, free consultation. There's nothing hidden behind that. Free consultation to review those, tell you what your policy currently does, what it doesn't do, and what you may have access to. We don't sell insurance. We educate on options.